Have you ever wondered how index funds work? Well, let's delve into it. An index fund is a type of mutual fund or exchange-traded fund with a portfolio designed to match or track the components of a financial market index. These funds adhere to specific preset rules aimed at tracking certain baskets of underlying investments. Index funds provide broad market exposure, low operating expenses, and low portfolio turnover. Now that we've defined what an index fund is, you might be asking, how does it work? To understand how index funds work, you need to grasp the concept of a market index. Let's imagine a market index as a measuring stick. It's a hypothetical portfolio of investment holdings that represents a segment of the financial market. The Standard & Poor's 500 or S&P 500 is a prime example, tracking the performance of 500 of the largest companies listed on U.S. stock exchanges. Now, an index fund is a type of mutual fund or exchange-traded fund with a portfolio constructed to match or track the components of a market index. It aims to mirror the performance of that index. So, if the index goes up, so does the fund. If the index goes down, well, the fund follows suit. But why do investors like index funds? Firstly, they offer broad market exposure. When you invest in an index fund, you're essentially buying into a slice of the entire market within that index, not just a single company. This diversified approach can help reduce risk. Secondly, they have low operating expenses. Since index funds simply mimic a market index, they require less active management, which translates into lower fees. Lastly, index funds have low portfolio turnover. This means there's less buying and selling of securities, which can lead to lower transaction costs and fewer taxable events. So, you see, investing in an index fund is like buying a small piece of the entire market within that index. Now you've understood how index funds work, it's time to weigh the pros and cons of investing in them. Let's start with the upside. One of the most significant advantages of index funds is diversification. Instead of putting all your eggs in one basket, index funds spread your investment across a wide array of stocks or bonds, thus reducing your risk. Another advantage is their low cost. Traditional actively managed funds often come with high fees due to the costs of research, transactions, and administration. On the other hand, index funds simply track a specific index, reducing these costs significantly. Furthermore, index funds are passively managed. This means you're not relying on a fund manager's skill, or lack thereof, to pick the winners. Instead, you're simply riding the market's wave, which historically has tended to rise over time. However, every rose has its thorns. One disadvantage of index funds is the lack of flexibility. Unlike active funds where managers can adjust holdings based on market conditions, index funds remain static. Secondly, there's no potential for outperformance. Since index funds aim to match market returns, they won't beat the market. If you're looking for a home run, this might not be your game. Lastly, there's the issue of market cap bias. Index funds give more weight to larger companies. This means you could miss out on the growth potential of smaller, up-and-coming companies. As with any investment, it's important to understand both the potential rewards and risks. So, are index funds the right investment for you? They offer a diversified, lower-cost way to participate in the financial markets. But they come with their own set of risks, like any investment. It's crucial to understand these aspects, do further research and consider your financial goals before jumping in. Whether you're just starting out or you're an experienced investor, index funds could potentially be a valuable part of your portfolio. Remember, understanding how your investments work is the first step towards making informed decisions. Happy investing! You may not know that YouTube channels depend on the total accumulated time their videos are watched. Channels also highly depend upon the number of subscriptions received. So, thank you for watching the entire video. To further help this channel, please click the subscription button below. In addition, if you enjoyed the video, you may also click the thumbs up button. Thank you.